Hello and good afternoon, everyone, and good morning to all of our speakers and guests joining from the US today. Welcome to GP Bullhound's SPACs webinar. My name is Maria Lazareva, and I will just run us through a couple of housekeeping items before we start. In today's webinar, we will look into the mechanics and advantages of special purpose acquisition companies, known as SPACs, and explore the reasons behind their sudden popularity. Adam Birnbaum, my colleague and executive director from our New York office, will start by giving an overview of SPAC transactions, after which he will be joined by a panel of legal and financial experts from Blank Rome, Glazer Capital, and True Wind Capital for a deep dive into the SPACs market. As always, we would love to hear from you. So if you have any questions during the presentation, please drop them into the question box at the bottom of your screen. We will take those at the end of the presentations. We will not take more than an hour of your time. This webinar will be recorded, and we will send a link of the recording within the next couple of days. Just a reminder to all participants just joining, please submit your questions via the Q&A box at the bottom of your screen, and we will get back to you after the presentations. With that, I'm handing over to Adam Birnbaum. Adam, the mic is yours.
Thank you very much, Maria, and welcome. And I'm delighted to have everybody here for this wonderful session on SPACs in the webinar. I'm going to start off with a very brief introduction to GP Bullhound and then move on to an introductory conversation regarding SPACs. So starting with GP Bullhound, we were founded in 1999, and from our inception and throughout, we've been committed to the needs of technology companies and technology entrepreneurs. We're started by entrepreneurs. We have a very entrepreneurial culture, and our focus has always been around that on a global basis. We have completed 550 transactions. We have over 100 professionals in 10 locations in 3 continents. We have a very, very deep presence both throughout Europe, through all the major metropolitan areas that are focused on the technology area, as well as San Francisco and New York in the United States. And San Francisco, in fact, was our second office and is growing very, very rapidly as we are in New York in all our offices. We've advised on over $20 billion of transactions. We also have a very, very vibrant and strong asset management area, which has enabled us to invest in some of the leading companies and technology companies in the world. Next page will just show you what our mission statement is, which we believe, and all of us in the firm commit to this, to honor the global tech leaders in their mission to build the future, and we do everything we can to commit to that. The next page will just show you we have 3 major segments to our focus. We have our corporate finance business, which is mostly comprised of mergers and acquisitions, and capital transactions. We have completed 430 transactions in the M&A world and over 120 rounds of financing. In the investment side of things, we have completed a number of leading investments for companies that you'd be very familiar with. Things like Spotify. We've invested in Slack, Klarna, and Unity, to name a few. We also have a very, very vibrant practice around our research area and in doing events like this committed to the needs of entrepreneurs. Next slide, please. We focus on 5 key segments. Those would be the software area, where we have a very, very strong practice leading and advising on some of the leading companies. To just name a very, very few: Signavio, Ecovada, SUR1. We have a very vibrant practice in the digital media area, where we work with companies like Quixel, Believe Music, AllTrails. In the marketplace area, we've worked with companies like Delivery Hero and Baltic Classified. In fintech, with companies like LendInvest and Mambu and Moniz and Prodigy Finance. And in the digital services area, which is also one of our strongest practices as well, we've worked with companies like Essence Communications, Insera, Jellyfish, Solida. So in short, this webinar is a good example of something we like to stay on the front end of all leading ways to help our technology clients, technology companies, both from the investment standpoint, capital raising, M&A standpoint, and we're delighted to have you all with us. I'm going to go into now a very, very brief overview of how SPACs work. So as we mentioned, the SPAC is really an acronym for the Special Purpose Acquisition Corp. I should start out by saying that this is not, although we've heard a lot about that recently, this is actually something that's been around for a number of years, but it's just taken on a lot more precedence recently. Ostensibly, a SPAC is a blind pool of money that's raised by a sponsor company, and then it is indeed taken public by that sponsor company, and you have investors that come into it. The sponsors usually have a pedigree. They have a commitment to have done something like this before, and that gives the public, the IPO investors, the interest in being able to raise a transaction like this. So just a few summary points on this. A SPAC usually has 24 months to consummate a transaction. The investors in the SPAC receive shares and warrants. Similarly, the sponsor who actually sets up the SPAC, they actually receive shares and warrants as well. In fact, their interest in the sponsor company comes through a private placement in the form of shares. And the two things that are important, there's a 24-month period of time when a transaction has to be consummated. If a transaction isn't consummated, the investment that the sponsor makes would be lost. So there's a real incentive to get a transaction completed in that 24-month period of time. Why the question may be, why would an investor invest in a SPAC? And they get to have an opportunity to participate while they're waiting for a transaction to be consummated. They receive interest income in the SPAC, and also they have an opportunity to get in on the ground floor of a very, very interesting company that they ordinarily wouldn't. So I think if we go to the next slide, I could take you through, and there's a lot of content on here, so I'll try to move through this quickly. But just to go through who the key participants are in the SPAC and what some of the trends have been since. So we spoke about the SPAC sponsor. They usually invest 3 to 4% of the capital in the transaction, and that's organizational costs. A lot of that goes to the initial gross spread that goes to the underwriter. They have to find an underwriter. They have to get the underwriter in tow. They have to go through, help identify the company that they're going to acquire, raise the capital for the IPO, and work with the target company to take it through the de-SPACing process. As I mentioned, if they can't find an acquisition, they lose their invested capital. The IPO investors, who are these participants? They can be private individuals. They can be hedge funds. They can be longer-term investors. In some cases, you'll have longer-term investors even participate as the SPAC is set up. What will the IPO investors receive? They'll receive shares and a warrant. And the trend we have seen is that the amount of warrants that they're getting, which is usually, is at a price that's usually 15% above where the IPO price is. And I should point out that almost every SPAC is done at $10 a share. That gives them the opportunity to participate in the upside. But the warrant as well has been going down in terms of the percentage of warrants that IPO investors have been receiving. So there was a time when you would always see one or maybe a half a warrant. We're seeing a lot now with 1/3 of a warrant, some deals being done with a 1/5 of a warrant. Now, interestingly, the IPO investor, they have the right to redeem their shares or hold the shares after a deal is announced. Sometimes you could actually vote for the deal and still redeem your shares and maybe hold on to your warrants. So this is an important consummating portion of what happens. The third part is the PIPE investors. This is something that you've heard about a lot lately in the last certainly 18 months, and it's becoming much more prevalent. And PIPE stands for private institutionally placed equity, I should say, which is not only indigenous to SPACs, but is a form of security that frequently public market companies can do. But I should point out that in the SPAC, it's become particularly important. A PIPE investor will have an opportunity to spend an extended period of time with the management team and the sponsor, understand the deal, understand the mechanisms of the transaction, help vet the deal. And it's actually an extremely important source of endorsement when a PIPE investor wants to invest alongside, and the commitment demonstrating that it's a transaction that makes sense and it's something that they would get behind. And why would they do it? It's an opportunity for them to buy a sizable block of shares in a company at what should hopefully be the early stage of the transaction. The company, the target company merges into the public equity of the company. So, a target company is looking at a few different opportunities, right? They could be looking at another round of financing. They could be looking at an IPO. They could be looking at a sale. And a SPAC is another vehicle for them to do that. They receive a combination of shares. They could in the going forward company, they could receive cash. There could even be an earnout structure. So there's more flexibility than you would ordinarily see in the traditional IPO. Just to go quickly through some of the trends here. In terms of the SPAC sponsor, you're seeing them change. So the SPAC sponsor on US IPOs almost always would get 20% pro forma of the shares that are to be outstanding afterwards, which is, can be significant. You're seeing changes in structures now where you will see the companies frequently get incentive structures. Maybe it's linked to stock performance. So you're seeing that evolve a little bit. And you're seeing a lot of that in Europe as well, in the European SPACs. You're seeing serial SPAC sponsors, people like, Michael Klein at Churchill, Chamath from Social Capital, who was very early on, sponsoring a number of SPACs. They actually help as an endorsement that the transaction will go well because they've had success in the past. Our present panelist, Truwin, was very early on and has a great reputation in being able to do that and be successful with that. And they've had some announcements about, or have had some news about, other SPACs that they will be raising recently. In terms of the IPO investor, and again, we have one of the leading investors from Glazer Capital here, who's very early on and one of the most active. What they're seeing is a greater supply of SPAC IPOs to invest in. In some cases, you're actually seeing a pop in the stock price. The size of the SPAC IPOs are increasing. And you've seen situations where SPACs have actually traded higher than their IPO price. In terms of the PIPE investors, some of the trends we're seeing is that there's a big backlog. There's a number of SPACs that are being raised, and there's that's impacting timing and pricing. And we'll get into that a little bit with the panel. You're seeing a lot larger PIPE deals being done. You're seeing some very, very sizable deals completed. We know many of the names. And as I mentioned, it's a vote and endorsement when you do get the PIPE investors in. In terms of the target, what does this all mean? Better terms, increased valuations, SPAC offs, quote unquote, where basically you have a number of participants SPAC, putting in offers and demonstrating interest in a good company that's out there. And the target companies, you'll frequently see that the target company is at least 3 to 5 times the enterprise value for these companies, or 3 to 5 times the capital that are being raised in the SPACs. And in the next slide, we'll show you why. So if we can just turn to the next slide. I think one of the things you'll see here is that we're going to do 2 scenarios here. And this is something when we get asked a lot, say, why are these SPACs always so much larger than the amount of capital that's being raised? I'm just going to try to use a very simple example here, that in a SPAC that raises $250 million and they're being valued at 10 times, when you take into consideration things like the deal expenses and the promote shares, this same SPAC that target is valued at 10 times, when you take these other things into consideration, the value is more like $300 million. And that's like a 12 times EV, which means a few things. If the public companies are valued at 10 times, and this is at a 12 times valuation because of some of these other dynamics, something's going to have to give. So that either means the sponsor may have to give up some of his shares or her shares. The target will have to accept less, or there's a story there that's going to justify why this should really be 12 times in the public markets because of something very, very unique. So you see that there's a bridge that has to be there's a gap that has to be bridged, I should say. Now, if you look at a company that you acquire, and as opposed to it being a $25 million EBITDA, but it's an $88 million EBITDA, then you have the opportunity to do a transaction that's, let's say, 3.5 times. and you see the same $50 million of bridge, which is what the SPAC sponsors promote is, now represents a much smaller percentage, and the overall valuation in the marketplace is 10.6 times. And then the question is, how do you get to this larger EV when they're only $250 million? Well, that's where the PIPE investor comes in. That's where shares that are being retained by the target company, gets into play. Maybe there's debt, which doesn't necessarily affect the capital structure, but it does provide you that opportunity. So I think this is a good demonstration to explain why deals are done, at higher EVs relative to the capital raised. The next slide will just take you through just some of the benefits and considerations of a SPAC. So again, it provides flexibility much more so than your traditional IPO. Unlike an IPO, you can get larger amounts of liquidity for your shareholders. Like an IPO, you get equity that you can be used to retain key employees, attract new employees, or also be able to do transactions with a public currency. The capital, there's capital available for growth. You have access now. You're a public market company. You have different ways you can structure things with the earnout, as we said. I think importantly, and I've taken a number of companies public in my career, you'll see that an IPO is a long process. And sometimes you get backed up because of a vagary in the marketplace, and it's just a painful thing. Whereas with a SPAC, you actually have extended periods of time where you can share things like forecasts on a confidential basis by working with some of the PIPE investors, and you just get a much better view. Now, the considerations I think are important. You are going to be part of a public company. The considerations from an accounting and legal side are important. You have to be ready for the public scrutiny. The proxy process, whether it's in the US or in Europe, you are going to have time that you're going to have to commit to that. And it's a regulatory body, and you just have to be prepared for that. As we mentioned, there is an embedded valuation discount due to the sponsor, but if it's a unique story to the marketplace, it could benefit very well. The deep SPACing process, which is the process where you're moving from the IPO investors to a shareholder profile that's a little bit more consistent with what you might see in a publicly traded company, that takes time. There's actually more meetings probably than you do have in an IPO, but you have a lot more control over where you're moving there. So you do know what's going on in terms of the deal structure and things along those lines as it moves. You need a demonstrable story and so on. If we can just flip to the next page, we'll just go through these really quickly here. The IPO, the SPAC market has been very strong. $96 billion. It's about 80% of the IPO market. Next slide. If we just go to the next slide, you'll see the average deal is about $325 million now in terms of capital raised. In the next slide. We are seeing, and we are a international company, and there's been a number of SPACs that are coming focused on Europe. There's a few coming in focused on Asia, but a lot of these have been listed in the U.S. and we list them here. But some are starting to get traded and on European exchanges like Lakestar, companies that are in the ESG area, and so on. Next slide. We talk here a little bit about the months to liquidation of the SPAC. As you might expect, the lion's share of them, 76% of them have 19 to 24 months left. You'll see by industry target, TMT tends to be one of the highest focused areas. And as we said, by region, 95% of them have been North American focused, but we see that evolving and changing. Next slide. You've seen a lot of high-profile transactions. There's one called Rover, which has just recently been done, which one of our panelists involved with, as well as Open Lending. WeWork, you've just seen, has just announced. Taboola is a big company in the programmatic media side. SoFi, obviously, in the lending side. You've seen DraftKings. So a lot of high-profile companies. Kazoo, which is a UK automotive company. So a lot of them Capital, Iron Source again with a SPAC started by Orlando Bravo, which is in the programmatic area. Next slide, please. Number of SPAC sponsors. This is a combination of private equity firms as well as people who we mentioned are like Michael Klein at Churchill, who have gone out and actually become experts in raising a SPAC capital, social capitals in there. But you see these are leading individuals, companies, including politicians. You're seeing across the board, and people who are leaders in their industries. Like Cushman Wakefield, RXR on the real estate side. Union Square Hospitality on the restaurant side. Next slide, please. You see a sample universe of PIPE investors and IPO investors. You see Glazer Capital, one of the leaders on the IPO side. On the PIPE side, you'll see a lot of the institutional investors that you see here are not dissimilar from the ones you would see as long-term investors in public equity or in IPOs. Next slide. And lastly, we just took a look at the performance of some SPACs for announced deals. These are deals that were announced in 2021 and how they've performed since their IPO. And for the most part, you'll see they've done extremely well, many in the 40 to 50% increase in price. There's been a few outliers there, but that's about it. So I think that sums up our summary. And I think before we consume too much time, I think let's turn this over to the panelists, and we can start our conversation. So I think if everybody can just go live here, this would be great. Okay, so I think what I would ask is that each of the panelists introduce themselves, and Vik, maybe we start with you, and then go over to John, and then go over to Brad, and if you could just give a introduction of yourself, your firm, where you focus, and what your view is of the SPAC market right now. Thank you very much.
Hi, this is Vik Mittal from Glazer Capital and Meteora Capital. I've just quick background. I started on the buy side at 2005 with Glazer Capital. I'm a partner and portfolio manager. Glazer Capital is a $2.3 billion AUM money manager in the event-driven market neutral space. We've been invested in the SPAC market since 2008. I run our SPAC and illiquid efforts. Currently we're probably a top 3 public SPAC holder with north of 5 billion exposure to SPACs globally. Included in that were investors in 20 to 30 sponsor groups, a handful where we have significant kind of non-managing member responsibilities on deal flow and sourcing and closing that we do off the Meteora Capital platform, where we have some experienced former SPAC board members and deal members who work closely with our sponsor teams on all aspects of IPO, putting the boards together, sponsor capital formation. We'll anchor the IPO book. We'll be their internal due diligence, M&A, and capital markets partners, and then we'll be supportive PIPE capital on the back end. And so that's one piece of the business, and then the other piece is that we cover the broader 450 plus SPACs and weight those and own those in different proportions based on kind of more of an algorithmic driven model of how we score and rank those sponsor teams and the relative value versus trust or option value that we believe that they have. And then we'll selectively play the highest quality pipes that can get through our underwriting standards. So we're really, we've of our AUM, which is around $2.5 billion, we're levered basically 1 turn on that towards SPACs, given the T-bill downside risk and the optionality. And so, we had a fantastic year last year. The funds were up 37.5% net, and in $700 million of allocated capital on SPACs levered, we were up over 130% gross. In 2020. And so, we think SPACs are a phenomenal trade. We've been in the market for over a decade, and we touch all parts of the ecosystem.
Great. Thank you, Vik. John?
Yeah, first of all, thanks for the GP Bullhound team for having me. Maybe quick background on myself. So I'm John. I'm a vice president with True Wind Capital. I've been with Truin for about a year. Prior to that, I spent 7 years with Audax Private Equity, based out of Boston, investing across a number of different verticals, consumer, healthcare, and technology. Quick background on Truin. So we are the technology spin out of KKR. So our two co-founders were formerly co-founded and co-led the global technology group for KKR. They spun out to form an independent platform called Glazer Capital back in 2015. Raised close to $600 million as a first-time fund to deploy across the technology ecosystem, anywhere from hardware, software, tech-enabled services. Fairly broad mandate, but generally speaking, kind of core technology, investing anywhere from 50 to 150 million of capital per transaction within the lower to middle market. Our foray into the SPAC market was actually back in 2017. I think we like to say we got into the SPAC trend before it was cool. We had the thesis that the IPO process was structurally disadvantaged. The SPAC product was an underappreciated and underrepresented way to go public. And for our fund, an interesting way of leveraging our kind of broad technology relationships, our expertise within taking a company public, and a mechanism to have an interesting risk reward profile for our own kind of LPs and investors within the fund to sponsor a SPAC. And so we raised our first SPAC back in 2017. We ultimately cultivated a transaction with Open Lending in June of 2020. So that was we partnered with Open Lending. It was a successful transaction. Coming off the heels of that, decided to, we thought there was a continued opportunity in and around the SPAC market to leverage our expertise and know-how and what we learned kind of the first go around with Open Lending, and saw a continued opportunity of companies that wanted to go public, but and thought the SPAC mechanism and product to do that was an intriguing way of partnering with those companies, and also putting our own fund capital behind it for the next phase of growth as a partner to those companies. So we raised another SPAC vehicle back in September of 2020 called Truin Tech Holdings 2, a $600 million vehicle to target larger targets. So targets between, call it 2 and 10 billion of TEV. And then another back in December of 2020, another 275 million to target kind of a similar size range to the open lending transaction in between, call it 750 million of TEV upwards to 2 billion. So those two products, the 600 and the 275, covered the full range of size outcomes within the SPAC market. We've had continued success in finding targets and continued conversations with potential targets on both of those products. As Adam mentioned, we recently announced a merger agreement with Rover, which is the world's largest online app for pet services, and think that will be a really interesting outcome both for for the company, for our investors, and for PIPE investors and IPO investors in our SPAC as well. Coming out of that, coming out kind of off of the out of the Rover transaction, we're in process of raising 4 additional vehicles. We have a $150 and a $250 million vehicle publicly filed, as well as a $400 and a $600 million vehicle filed as well. And so we're starting to institutionalize an approach around the SPAC product. So we have our core private equity fund, and we're standing up a business unit in and around SPACs, which we think will continue to be a very intriguing way to go public, a really interesting way for us to leverage our network and find investment opportunities for our fund, and think there's continued runway and opportunity to do so, and partner with interesting companies that want to come public. So maybe one observation about the SPAC market in general, as as we were asked to provide in the beginning. Yeah, I would say the SPAC market, it's constantly evolving, probably evolving quicker than other financial products and financial asset classes that we've seen. I would say, given the lower barriers to entry to actually raising a SPAC versus raising a full private equity fund, I think we'll see a quicker evolution of the asset class than we might have seen in private equity and other kind of comparable investing classes. And it'll be a really interesting next couple of years. I think the market will become increasingly competitive, both in terms of pricing and promote to sponsors. I think we'll see continued movement towards more aligned incentives, similar to a private equity structure where sponsors get paid on a positive outcome. I think, comparably in the SPAC market, promote will ultimately move towards where, sponsors are getting paid for positive outcomes and aligning incentives with both investors, management teams, everyone who's involved and on a good outcome versus just a trade. And ultimately we'll see a kind of a filtering out of the noise. So fundamentally, back to first principles here, the SPAC product is a way for, companies that should be public and want to be public as the next kind of sequencing of their growth. And it will continue to be that. And I think there'll be a filtering out of companies that probably shouldn't be public and need more time in their growth and development to consider going the SPAC direction. I think we'll ultimately you'll see a tiering of the companies that are poised to perform well, were the ones that should have and were mature and had the right management teams and the structure to be successful in the public markets. And there'll certainly be a filtering out of those that may have been trying to take advantage of more frothy public market valuations and sponsors that probably didn't have the infrastructure to appropriately appropriately approach a true SPAC process and drive a successful outcome. So I think we'll see an interesting evolution towards a tiering of both sponsors and companies, and an evolution of the asset class to where incentives are aligned and ultimately it becomes more competitive as we proceed over the next couple of years.
Great.
So I'm happy to be here and happy to provide the sponsor the perspective from a sponsor side as we get into Q&A towards the end.
Perfect. Thank you so much, Sean. Brad?
Hello, everybody. My name is Brad Shiffman. I'm a partner at Birnbaum LLP, a law firm, national law firm with its principal offices in New York, Washington, D.C., Los Angeles, Houston, and Philadelphia. I have been working on SPACs for about 15 years now. We have a very diversified practice in terms of SPACs, from working with issuers and underwriters on the IPOs to helping those companies that have completed their IPO work through the process to get to a business combination. We've worked on numerous business combinations, both from the issuer side and from the target side. Some of our more recent and successful deals, we're working on the first Churchill business combination with Clarivate, and the recent Novus App Harvest deal, which received a lot of publicity because of their space. We also work with investors and funds who are either seeking to do a PIPE or make another strategic investment, or some funds which help de-SPAC some of the SPACs in terms of making certain investments to buy shares and hold them and sell them at a later time. It's all different kind of things. We have a full service firm, so we can not only assist the SPACs, either the sponsors in connection with forming a SPAC, SPACs with doing the acquisition, but working on all aspects of the business combination as well. A couple observations. I agree very strongly with the other panelists that the market is evolving. I also agree with what Jonathan said, that you will see a lot of culling out of some of the companies that do not belong public, but probably more importantly of sponsors that are not, or do not have the track record or really the infrastructure to complete successful deals. Right now, there are over 500 public deals, public SPACs out there, of which over 400 are looking for targets and another 100 have announced targets. So it is a little frothy. It's probably, this year could very easily have the most IPOs. Approximately 70% of the IPOs will probably be from SPACs. So there may be too many companies that are going public as a result. This has happened before. There was a big boom in the SPAC market back in 2005 through 2008, and then it died down partially because of valuations, partially because the market got killed, and a structural issue with SPACs, and that many SPACs are not completing their acquisitions. I think the SPAC market is a little bit different now in the sense that you have more established players, more credibility in the SPAC market as a result of some of the established players coming in. So I think it is here to stay. I don't think it'll stay at the level that it is, but I do think you will continue to see the SPAC market representing a sizable portion of the IPO market.
Great.
Adam, I'll turn it back to you.
Thank you, everybody. So let me start with a question, because we're seeing this in a lot of the activity that we're involved with as it relates to SPACs, and it's something that we're all feeling. So the pipe market, you got a lot of draws in people's attention. You got a lot of deals trying to get done. It's getting backed up, and it's impacting pricing and valuation. So I guess Vik, John, just kind of curious your commentary on that, how you see that working itself through, and so on.
I can start, just being, having decent public exposures. I would echo a lot of the comments I heard. I mean, the SPAC market's choking on too much paper, and too much bad paper, in my opinion, on the front end. And so now that's leading to a process on the back end where the market's choking on too much pipe paper. We're wall crossed on over 30 independent situations that we're not part of the sponsor group on, when historically we were wall crossed on 2 or 3 at a time. My understanding is firms like Fidelity, T. Rowe, they're being wall crossed on 70 to 80 situations right now, and there's just not enough bandwidth in hours. We have one SPAC that we're on the sponsor side that's in the pipe process right now, and the founder CEO is decent friends with a PM at one of the major long only shops, and his compliance department is saying that it's a 2-week backup before they can even get through their compliance backlogs to wall cross the investing side. So we're seeing that logjam. We're seeing price cuts in the 20 to 25% range on deals that are going through the pricing exercise, like Iron Source was 17%. So sorry, and pricing came down 17% there. The pipe came down. The pipe size, I believe, was decreased, or there was the Fortress deal for ATI that the sponsor turned their promote into an earnout, and they put 100 million, I think, of LP capital in. So what you're seeing, I think, is very healthy from the public market side, and that the valuations are being restruck to the right levels where large sophisticated institutions will clear deals, and only the best of the best deals that are being underwritten over a 30-45 day period by very sophisticated institutions are able to raise pipe capital now. So for my public business, I think that's fantastic, because 75% of the SPAC universe is like a yield play, so it's a very easy T-bill plus call option trade. And at the top 25% of the market, if you're able to identify the sponsor teams that have the ability to underwrite, secure, and sell to the street high quality private companies transactions via an IPO effectively, there's real call option value. I think the days of retail bidding this stuff up 20 to 100% are gone, but certainly you're seeing these transactions, and even in the last week, trade up a little bit because institutions kind of price them correctly to where they think fair value is and where the story has room to grow if the company executes.
That's great.
Yeah, I would agree with a lot of what Vik said. I think that having 70 to 75 pipes out there that folks like Vik are spending time on, it raises the bar on the discipline and the thoughtfulness of the approach that the sponsor has to have when taking a business out to market. Right, it has to be a well-priced, well-structured transaction in order to get the time and attention it deserves from the right pipe buyers, and get the right folks and names around the stock, both from the the investor landscape, but also the analyst landscape and others that you want spending time in and around the name. It's probably healthy in that it's so choked up, it's almost promoting a more rapid acceleration of the evolution I was discussing, where only the T. Rowe's, the Fidelities, the Glazers of the world, they're spending time on the best names, right? The sponsors that I think are best suited to take business public, and those businesses that have the right kind of the right valuation and are anchoring towards medium and longer term outcomes that are good for everyone. So it's raising the bar. I think it's important. I think there's probably 70 deals out there right now, as Vik mentioned, because folks were anchoring on extremely frothy valuations from the public markets back in December and January. And I think we all recognize how that may be unsustainable. And look, if you roll that forward a few months, and it's not surprising that these transactions are getting repriced 20 to 25%. But I think it's healthy. I think it's important, and I think it's going to cause a quicker acceleration to those outcomes, that transactions that should be public and should be at the right price.
Great. Hey, Brad. Next question is for you. There's been some news in the press about the SEC doing a closer investigation into some of the activity that's going on in SPACs. So that is always, the word SEC and investors is always alarming. So what's your take on that? What do you think? What's your view on what's happening, and how you think that's going to affect things?
Well, yeah, the SEC is definitely looking at SPACs, and part of it has to do with because of the big run up in the number of deals. Some of the fact that some of the deals have had some issues, such as the Nikola deal. You've seen some wild trading in stocks. For example, the last Churchill deal ran up to 60 before it announced the deal, and then dropped back down into the 20s. So there's a lot of things that give pause to the SEC. First, I do want to point out that it is not a formal investigation. It's merely an inquiry. They've asked for the investment banks, to provide information voluntarily. They're looking at things like what the procedures, at least as of now that you could tell, they're looking at the procedures that the banks have in place, on transactions, what their volumes are, how their pricing mechanisms, and all types of things like their fees and disclosures. It's a furtherance of what the SEC was doing back in December. Back in December, they issued some guidance for SPACs, both in terms of the IPO, in terms of what kind of disclosures there should be to make sure that the terms are clearly disclosed, what the insiders' interests are, how they're going to profit if an acquisition happens, and what conflicts there are. They also were looking at the business combination side. When the companies get to the point where they're doing a proxy statement or registration statement to complete their acquisition, again, they're looking at things like conflicts and how much money the insiders make and how their interests differ from the public. They're looking to see that things like pipes are accurately disclosed, that the underwriter compensation and any fees and services that may be provided following the IPO are closely described and what they're being paid for it. So at the end of the day, do I think the SEC will do? I think they'll issue some kind of statements at the least. They'll probably have more disclosure requirements. They may turn to the exchanges for the stock exchanges for more guarantees or more requirements for listing. They may take actions in select cases if they find either fraud or they find complete lack of disregard on certain participants, but I do not think that this is going to be an industry kill type event. I don't think that they're going to come down on SPACs. They're just looking to ensure that the public is protected.
So great, appreciate that. So Vik and John, the preponderance of deals are getting done. We saw the average is 300 million. It's north of that. You're seeing a number of transactions much larger than that. John, it's sort of, you're on the sponsor side. Vik, you're looking at basically having the opportunity to look at all deals. Are there deals that you would see, getting done smaller than that? I mean, we all understand there's a liquidity issue as it relates to IPOs, but are there scenarios where you could see there's more opportunity maybe there? So what's your comment on, SPAC size? Maybe we start with you, Vik.
Yeah, I mean, I think I actually like the diversity we're seeing in the opportunity set. You've got the smaller SPACs doing the sub $1 billion deals. The more, bulge bracket prestigious SPACs like John's that are going out with the bigger banks are the ones that are, really able to get in the SPAC offs when Credit Suisse or Morgan Stanley has some company that they invite 5 or 7 sponsors to, that they think are thematic fits and can add value and can raise an institutional pipe against it. Those deals, are the ones replacing the traditional IPO market and are the more viable, mature assets that have, developed cap tables with real venture capitalists or private equity owned businesses, with real institutional infrastructure from a CFO, CEO perspective. They're not earlier stage companies. And so I think that's why you're seeing the market really moving towards the bigger deals for the pipes. And the smaller deals, I think the pipe market's not as developed for those, 500 to 750 million deals. And unfortunately, I think most of those deals are the ones that'll get announced without a pipe. 100% will redeem, and the stock will trade down to $5, $6 in a couple years. And that's what everybody talks about when they look at the Wall Street Journal and stuff, and they cite statistics on how SPACs are such bad investments, because they're really, it's taking companies public that shouldn't be going public, that aren't mature enough. And so we'll see a lot of that, where that froth and euphoria from the second half of last year really comes out in a lot of these names, and the stocks trade down, significantly once they miss a couple quarters and the market realizes that they're not going to meet the projections and things of that sort that that they put out when they announce their deals.
Interesting. John, so you guys, go ahead.
No, I was going to say, I agree. I mean, as like a rule of thumb, I would say if the business is smaller than 500 million of TEV, give or take, I think you run into the issue where you might, in a underperformance scenario, you might run into a thinly traded, not closely covered or followed situation, and that can be a challenging situation for a sponsor, for others in the cap table, for management, and when you get kind of stuck in that small cap no man's land. I completely agree with Vik. Like, I think you'll probably see situations where companies that were right on the cusp decide to go the SPAC route, may not be ready, both from an infrastructure perspective, from a management perspective, and maybe threshold from having the adequate float needed to be a healthy public company from a liquidity perspective. So I would just recommend to the folks that are considering it, hey, are you adequately suited to be a public company? And is that if you're a high growth software asset and you're approaching 500 million and you're quickly, that's quickly going to be $1 billion, that may be the case if your TEV is rapidly scaling in a high growth scenario. But you introduce another element of risk when you're trying to be a public company at the wrong time. And so, yes, maybe there's more opportunity set for sponsors to go find smaller companies that are not running broad SPAC offs with real institutionalized sponsors, and just like you see in kind of the lower middle market of private equity. But yeah, I would not recommend the SPAC route unless the business is sizable, has the infrastructure to be a public company, and is going to have a scenario where there's adequate float and coverage to be a healthy outcome for everyone.
Great. So I think what we're going to do is we're going to open this up to the audience for questions, because there's a lot of them. Flying in. So and whoever wants to respond to them would be great. So one of the questions was a follow-up when we were talking about the pipe market, and they said there'll be a discount in valuation, as a result of the pipe market. So I don't know, Vik or John, you want to comment on what does that mean in terms of the participants in a SPAC? So how does that play out?
I'm sorry, could you repeat the first part of that question?
In terms of the pipe market, seeing discounts and valuation, how does that play out as it relates to the SPAC participants? That was the question.
Oh, well, I don't think pipe. I mean, it's more so the transaction. So say from what we're seeing on the pipes we're working on to underwrite for our public book, you're seeing a company come out at, the bank will bring it out, the wall cross accounts at a 2.2 billion valuation. Accounts will start digging in, do management meetings and all of that other stuff. And through that process over 20, 30 days, if institutional demand's not there, you have to find a new clearing level on the pipe. So the valuation usually resets in this market environment down 20%, say, is what's been happening the last few weeks on average. So that valuation will get cut down to 1.8 billion. So the pipe investors are still buying the new public commitments to own shares on the back end when it closes at 10, but it's just the valuations being reset. And that's healthy for the front end guys too, because, and that's why I think retail and others like SPACs, because you have access to IPO-like type investments at 10 with T-bill risk versus, being crowded out of an Airbnb or DoorDash IPO where the banks are, picking and choosing who gets the allocations. And so that helps from that perspective. The part that I guess is dampening now is that the valuation is getting set at the right level. So you're not seeing these huge day one pops, but that's good for the target companies. It's good for employee morale. It's good for everything else. No one likes to see their IPO price and then trade up 100% that some new investors that just came in day one are making these insane returns, and legacy venture capitalists or owners of the business have taken that level of dilution, so to speak, on their ownership at a 50% discount where the right clearing level is. And I think that's why the market's moving away from IPOs to SPACs, because the SPAC is doing a better job of setting the clearing level, even with all the sponsored dilution that comes in. And to that other point about the bigger deals being better, the dilution's less. If John's got a $300 million SPAC and he's doing a $4 billion deal, the dilution from his sponsor promote and the public warrants is probably going to be less than 2-3% of the overall cap table. So that's a good place to be for a private company, because you get certainty of funds from the pipe. You have a confidential, quiet process, so any valuation cuts or anything like that are not well telegraphed to the market. It's done among 20 to 30 sophisticated institutions that are looking at the pipe, and you're able to sell projections for a lot of these companies. That's critical because they're being priced off forward multiples, and it just creates, and you get the institutional sponsorship of having a strong, hopefully sponsor partner that will help the company grow and help it meet its financial guidance and help mentor it as it goes public, which is very different than running a private company. So I think all of those advantages of SPACs is why there's a decent perception that a lot of companies, and this is what we're seeing in practice, that may have considered the IPO market are now using SPACs. It's not only just companies that couldn't use a traditional IPO that are using SPACs.
Great, thank you. So John, another question that came out is, how do you go about identifying companies that you think are good candidates for SPACs versus your private equity portfolio?
Yeah, it's an interesting point. I mean, we approach the SPAC product almost like it's growth equity investing at scale. So our core private equity fund covers the gamut of total enterprise value of anywhere from 200 upwards to 500, 600, 700. And the SPAC product allows us to find interesting investments at higher TEV. So it's effectively, allows us to hunt in that different universe. But we're looking at the same types of business profiles that we would in our core private equity fund. And we do the same fundamental diligence that we would do and approach a long-term investment out of our core fund. So we're looking for businesses with large TAM, high quality management team, scalable unit economics. We specifically don't take technology or revenue risk. So these are generally mature companies with proven product market fit in industries that we know well and have credibility and expertise in. So when we go and proactively identify SPAC targets, it's really high quality businesses that we would love to invest in out of our core fund, but they're a little too big. And the next phase of growth in their logical progression is the public markets. And so we think having a SPAC product is an interesting way of covering that enterprise value range. Allows us to put our fund capital to work. So we're typically and have put in pipe out of our fund. There's been situations where we're backstopping the transaction out of our fund or investing alongside. And so, it's like it's a really interesting product and a way for us to find high quality businesses that are typically out of reach of our core fund, but that we think are well suited to be long-term investments for us.
Great. So I think we have about a minute or two left. So somebody had a question about, what's the future of SPACs and so on. So maybe just to make it more concise for everybody, why don't we just get a prediction on how many SPACs will file, new deals. So new SPACs, not this year, because we're already way ahead, but next year. So what do you think the number is, Brad? Let's start with you.
That will get done between 400 and 500, which, and if you put that in perspective, you're at 250 this year already.
So you think 500 in 2021. How many do you think in 2022?
Oh, I'm sorry. I meant 2022. This year, I think you'll see somewhere around, it won't be 1,000, but it'll probably be somewhere around 700. Okay. So 700 this year, maybe 400 to 500 next year.
John?
Yeah, I don't know. I'm skeptical that the equity markets will hold and the pipe markets will hold up enough to pump that much volume. I think we saw a really interesting quarter where you had a little bit of euphoria coming out of Q4, where there was some interesting transactions being done with very frothy public markets. I see probably a slowdown here as the pipe markets just focus on the best opportunities and the quality businesses. They just don't have the time to focus on hundreds of opportunities coming through the door. That being said, if you I couldn't get someone to pick up the phone to talk about a SPAC transaction, last year at this time, and now I'm sitting here talking to 401 participants about the SPAC product. Who knows? It could be Brad may be wrong to the low, and I'm probably half of where half or a third of his number. Right. But if you ask me what my expectation is for the market, I think I would hope, and I foresee a filtering out of only high quality companies that both the public markets, retail investors, and pipe markets want to invest in. And a filtering of sponsors that have the credibility and the institutional backing to to bring those companies through a successful IPO process. And I hope that number somewhat approaches the number of companies that should be going public in their life cycle. And that's probably a number less than what we're seeing now. And but still an interest, for my own sake and for companies that want to go public, I think still an interesting and credible way of going public. And I believe in the product. Right now, the process is a long way to go.
Great. Thank you. Hey, Vik, do you want to close it out? What do you think? We have about 30 seconds here.
No, yeah, I think, from my perspective, it's a phenomenal opportunity to be a top tier sponsor, because the SPAC market's opened up in a huge way for private companies that are open to the SPAC product. So, and then as a public market guy that runs a big diversified book as well, I'm excited as well. On the sponsor side, I feel really good about the sponsor teams we're working with, because they have access to some of the best deal flow on the street. And you can see some of the less branded teams are really struggling, and they can only compete by overbidding for assets, but then they can't win pipe processes, or they can't get pipes done, and they can't win the confidence of boards either. So that's great. And then what it's also creating in my public book is this huge yield opportunity where you can have T-bill downside risk, and a lot of these SPACs trading at 960, 970, 980. And if they announce a great deal, great. The odds are very low in this environment, given there's 550 SPACs. And I personally don't think there's more than a couple hundred viable companies that can use the SPAC route to go public and raise a pipe, more importantly, at reasonable valuation. So I think the top of the market will do great, and the bottom of the market will be weeded out. And I think that creates a fantastic yield play on the bottom side of the market for more of our market neutral arbitrage strategies.
Perfect. Thank you. So listen, I wanted to thank everybody. Please reach out to us. We're very active in the market. There's a number of things we're working on, and we'd love to be helpful as to all the other parties. I'm going to hand this over to Maria just to close out for everybody.
Thank you, Adam. A big thank you to our panelists as well, Brad Shiffman, John Gray, and Vik Mittal for sharing their time and their thoughts with us today. If you have any questions after the webinar, please reach out to anyone from the GP Bullhound team. Thank you to everyone for joining. We hope you leave today with some new ideas and insights, and we look forward to welcoming you again very soon. Have a great day.
Thank you, everybody.
Thank you. Thanks for having us.
Thanks for having us. All right.
Thank you.